Hello and welcome to a special show on the new CPI data. Why I'm calling it new? Because it is on the new base and the numbers are flashing on your screen. The January CPI has come in at 2.75%, and this is on a revised base. To take how these numbers matters, what is the significance, we have a good host of panel, and let me welcome the panelists here. Madan Sabnavis is joining. We also have with us Rajni Sinha as well as Sachchidanand Shukla. Madan, I want to come to you first. 2.75% is the number which has come in for January. More than expected or in line?
No, almost in line. We had 2.9%, and this was based on the fact that we had the old series. So we felt it would be between 0.25 and 0.4% higher. So while putting in these numbers, we came to a number of 2.9%. So I would say 2.8% is largely in line with our expectations.
Right. So in line with the expectation of Madan, I want to come to you, Mr. Shukla. How do you read the primary number which has come of 2.75%? How does it look? Sachchidanand Shukla ji, please unmute yourself and then speak.
Hi, sorry about this mute and unmute thing.
No problem.
I think this number is par for the course. Most economists had a number closer to 3%. Essentially, the point was everybody was expecting a 30 to 50 basis higher than the previous base numbers, right? The old series. And therefore, the number that has come out, 2.7-ish, is more in line with most economists' expectations. I think the way to look at this probably is that this is more like a speedometer that has been really recalibrated, right? We can measure the inflation numbers better, but this is a journey. And like the Secretary Mosby has said, we are going to be rebasing and redoing this every 3 to 5 years. At least that is the aspiration. And that's how most modern economies come up with these numbers. So I think in terms of level, 30 to 50 bips higher is par for the course. What it will do also is the volatility goes down and the policy relevance really increases.
Yes, the volatility goes down. Definitely, the volatility goes down because the component of food has been revised to around 37% now. I want to come to you, Rajni, for your reaction on 2.75%. Wide expectation was there. It is going to be at least 50 bips impact. And do you think the numbers are incorporating that change?
Yeah, this is broadly in line with our expectations, and I would say market expectations. Overall, the expectation was that this month's data will go up because as the base effect starts playing the low base that we had last year, the expectation was that it would go up. And with the new series, yes, there has been some change in reclassification and some change in weights. But overall, like we discussed, the food basket, the weight has been reduced. So the good thing is that going forward, the volatility that we have seen due to food prices fluctuation, that would be relatively low. Relatively low because it would still be, percentage share of food in our CPI basket is still high. So that aspect, that volatility will still be there, but it would be relatively low. And like Sachchidanand mentioned, it would be a good reflection. Now, with the new series, CPI will be a good reflection of the current consumption basket. So, in that sense, we'll get a more accurate assessment of inflation going forward.
Right, and we have more details and constituents of the inflation. Urban inflation has come in at 2.77%, and the rural inflation is at 2.73%, in line with the headline number which has come in for January month. Madan, urban inflation, rural inflation broadly in line. Overall, I want to know the new things which has been incorporated in the new series, whether you talk about e-commerce or other things. Do you think from a policy perspective, it will have an impact?
Yeah, definitely from the policy perspective, this would have an impact because once, every time there is a policy decision to be taken based on inflation, we look at which are the components of inflation, which are the components of CPI, which are being showing upward movement or downward movement. Now, when we're talking in terms of the revised series, I think we're able to more accurately look at which are the segments which are really leading to the inflation. To that extent, it helps for more targeted policy formulation. But if you're talking in terms of overall monetary policy, to my mind, they will probably continue with 4% targeting. And as we have seen that when we all admit, okay, I agree rather, that the difference between the old and new series is not more than 50 basis points, this would actually mean that monetary policy can carry on in a normal course of in a normal course. We don't really have to alter any way of looking at inflation. Only when we come to the explanatory power of inflation, when we normally differentiate between core inflation and non-core inflation, I think that's what will make a difference. And since food items have come down, core components have gone up, I think policy would tend to be more effective because theoretically, monetary policy is something which can affect core inflation rather than food inflation, which are determined by supply side factors.
Right. For the viewers who have just joined, the new series CPI inflation has come in at 2.75%, and this is versus 1.33% in December 2025. This was on the old base. I'm sure the base would also have been revised as per the new data. But rural inflation at 2.73%, and so is the case with urban inflation as well. Rajni, which are the constituents one should watch out for, having said that the food constituent is now revised downwards?
So actually, a lot of changes have happened. One, new items have been added. Second, more markets have been added. Thirdly, even online markets have been added. And a lot of new items which were not being consumed earlier and which are more prevalent now, like, digital devices, then a lot of online app-based services that now we are using. So a lot of these new things that are there now, those have been included. Yes, food component, the weights have gone down. It's if you look at what are the components for which it has gone up, it's more of travel, communication. As you would expect for these items, the weights have gone up. And this was quite an expected line because as an economy develops, as the per capita income increases, the households would start spending relatively more on discretionary items, and the spending on food and the basic necessities would relatively go down. So broadly, that's what the consumption basket is also showing. And like Madan said, now we will have to focus core inflation overall, the weight of that will go up. So what's happening to non-food items, that would have a relatively stronger influence on overall CPI inflation. And that's what we need to watch out for.
Right. Overall, the numbers I can see, the food inflation has come in just above 2% or 2.13% food and beverages. What is your take on these numbers, Mr. Shukla?
So I think on the expected lines, because the share of food has really gone down, it was only expected that the non-core really now starts to become more important from a policy perspective. If you look at the core share, it goes up by almost 10 percentage points. Now, more services really come up, food really going down. Within services, housing really goes up in terms of importance. Education, health, transportation, all of these really go up. But I want to make a larger point. In terms of the gauge that we are talking about, it is more retail inflation and it feeds into monetary policy. But inflation is a much wider concept, and it has got a lot more stakeholders who use these numbers, and they don't necessarily rely. So I did mention about the speedometer in terms of retail inflation has become much better because of the factors Rajni and Madan and I mentioned earlier. But the point I want to make is, if we want to use it as a compass for policy making and not just monetary policy, for wider policy perspective, I think it is very important to understand that we will still continue to rely, or we will have to continue to rely on other gauges. For example, since we don't have the PPI producer price index, we'll have to continue to monitor WPI. We'll have to continue to monitor the GDP deflator, which is again a mix of WPI and CPI. And similarly, for some of the other measures like inflation for industrial workers, CPI, IW, and multiple other such measures. So the point I'm making is, yes, as a speedometer, this has become much better. We can gauge the speed and it is much more accurate in terms of policy, monetary policy specifically. It is much better. It supports better policy making. But I think we'll continue to, when we're looking at a compass, I mean, inflation as a compass for broader policy guidance, we will have to continue to monitor some of the other measures that I said, because we still lack the PPI. We still don't really measure services in terms of how it should be measured, etc. So I think we also need to be cognizant of the broader aspects and the multiple stakeholders that use inflation data. So let's probably look at it in terms of not just retail inflation, but inflation as a whole.
Definitely. Let me read out to the constituents of the inflations which has been released. Food and beverages, as I highlighted earlier, 2.11%. Pan, tobacco and intoxicants is at 2.86%. Housing, water, electricity, gas, other fuels are 1.53%. Furnishing and household maintenance, 1.45%. One outlier I can see may not be a major constituent, but personal care, social protection and miscellaneous services is that come in at 19.02%, restaurants and accommodation services at 2.87%. So largely in line, what I can read out. Madan, what is your take on personal care, social protection, miscellaneous services, more than 19%?
So I would tend to think it's once again the impact of gold, because I think that's what we had even in the earlier series. And the fact that gold has seen a phenomenal increase even in the month of January, and in fact for the entire financial year. So I think that is something which is getting reflected. But I would also suspect that other components of personal care, like in the manufactured products, I think that is something which would have seen an uptick. Maybe not to the extent of 19%, but more in the region of 3 to 4% is what my sense is. Because we have seen that the cost of inputs have been going up over time, and some of the companies have started increasing the prices. Now, this said, it should also be noted that ideally we should have been expecting some kind of moderation, because after the GST 2.0, which was introduced, manufactured prices have tended to also move downwards. So I think we'll have to look at the breakup of this personal care components. Gold, of course, gold and silver will be the ones which are driving these high numbers. But even the other components where input costs have been going up, GST has been pushing the prices down. I think that net impact would also probably have to be looked at in some detail.
Rajni, I want your comment on two things. Clothing and footwear around 3%, 2.98%, and education services 3.35%. Do you think this is, inline kind of a trend?
Is this question for me? I couldn't hear.
Rajni, I wanted your comment on the constituents of the inflation, which I just read out. Was education services at 3.35% and also clothing and footwear, which also is around 3% at 2.98%.
So, I would say this is broadly in line with our expectations. So actually, going forward, the factors that are going to influence inflation, because if we look at core inflation, demand side inflation, that pressure is not much. In fact, the rise in inflation that we are going to see going forward and what we have seen in the last month is one, because of the base effect, and second, because of the sharp increase in precious metal prices that we are seeing. But otherwise, if you see in the other components, like the categories that you are highlighting, the inflation is low and it's broadly in line with expectations, because we are still not seeing strong demand side inflation in the economy.
Right. Madan, I want your comment on the governor's commentary, which was there in the last monetary policy. Of course, there was the guidance was raised a little bit for the next year as well, breaching 4% now mark. With the numbers which has been released in January, do you think there is a further scope for revision of that guidance in the next monetary policy?
No, I don't really think so, because I think the way in which inflation is going to move, it is going to go above 4%. So even if you're looking at the fourth quarter of this particular year, I think the RBI had guidance of 3.2%. This may probably be in almost something which would be maintained even under the new series. And the numbers of 4.2, I think that was what was given for Q1 and Q2 of next year, unlikely to be changed because of this upward bias, which would tend to be in the new index compared to the old one. Though I suppose when the RBI gave the guidance of Q1 and Q2 of next year in the policy, it will have been based on the old base, because the RBI did mention they're not giving the full year forecast because they were waiting for the new index to come out. So it will be broadly in the same line. Above 4% is what I feel, which also leads to the conclusion that maybe the interest rate cycle is over and it will remain at 5.25% for a longer period of time.
Right. All right. So all eyes will be there on the monetary policy. How does the new series impact on the decision of RBI governor in the next monetary policy? But gentlemen and Rajni, thank you so much for joining at this hour with your views. Of course, the base year has been revised. It is more relevant. It is more contemporary, and there is always a scope of further revision, which was mentioned by government as well. It will be done in 4 to 5 years interval. Thank you so much. With this, it's time to take a very quick break. After the break, a lot coming up.
In association with Skoda Supercare.